there, and welcome. All right, today we're going to put on our detective hats. We're going to look right past those shiny feel-good headlines about company profits and uncover the real reason why some companies that look incredibly successful on paper can suddenly, well, just vanish. Let's dive right in.
I mean, have you ever seen this happen? A company's posting record earnings. Its stock is flying high. Everything looks absolutely perfect. You might even decide to invest. And then, just a few months later, poof, they're filing for bankruptcy. How on earth is that possible? Well, that's the central mystery we're cracking today.
You know, the answer lies in this trap that so many investors fall into. It's a phenomenon we'll call paper wealth. It's what happens when a company looks incredibly rich on its income statement, but in reality, it's running on fumes. Investors get fooled by these misleading profits all the time, and we're going to show you exactly how to see right through them. Okay, let's kick off our investigation. In this first part, we are going to expose the fundamental and often fatal difference between the profit a company reports and the actual real cash it has sitting in the bank. And trust me, this is the most important concept to get your head around. So check this out. It all boils down to this simple comparison. On the left, you've got net income or profit. Think of this as an accountant's opinion. A sale gets recorded the second a deal is made, even if no money has changed hands. But on the right, operating cash flow. That's no opinion. It is a cold, hard fact. It's the actual cash that's in the company's bank account, period. Let's make this super simple with a milk tea shop. So imagine a huge customer orders 10,000 yen worth of tea. Awesome, right? On your income statement, you immediately book that revenue. After you subtract 2,000 for your supplies, you've made a really nice 8,000 yen profit. You look like a business genius. But hold on. The customer said they'd pay you next month. So you've received 0 actual cash, but you had to spend 2,000 in real money on all your supplies. So your profit is plus 8,000, but your cash flow is minus 2,000. See the problem? This is exactly how a profitable business goes broke.
So there's a name for this culprit, and it's accounts receivable. That's just the fancy term for the money your customers owe you, just like in that milk tea order. So here is your first big clue as a financial detective. Whenever you see profits soaring, but you see accounts receivable ballooning right alongside them, that is a massive red flag. It means the company is making sales on paper, but they aren't collecting the cash.
All right, so now we get the difference between paper profit and real cash. Now it's time to learn how to run a proper diagnosis. In Section 2, we're going to use the cash flow statement as a powerful tool. Think of it like a financial blood test for any company you're looking at. Every single cash flow statement has these 3 vital signs. First up, CFO, which stands for operating cash flow. This one's simple. Is the core business, like selling that milk tea, actually bringing in cash? Second, CFI for investing. Is the company spending money on new factories to grow, or is it selling off its old ones just to survive? And third, CFF for financing. This tells you if the company is taking on new loans or if it's paying back its old debts. Okay, and here's where the magic happens. Just by looking at the plus or minus signs for these 3 numbers, we can instantly figure out what kind of company we're dealing with. So take a look at the healthy cash cow. It's making cash from its business, it's investing in the future, and it's paying back debt. That's the dream, right? Now, the ambitious growth star. It's also making cash, but it's investing so heavily that it needs to borrow money to fuel that growth. And then you've got the one you got to watch out for, the ICU patient. Its main business is losing cash, so it's forced to sell off its assets just to stay alive. That, my friends, is a company on life support. All right, time to peel back the final layer of the onion here. We've seen how cash flows in and out, but how do we really know if a company's growth is creating wealth for its owners or just digging a deeper hole? This is the ultimate test. The answer, my friends, is a beautiful metric called free cash flow, or FCF. This is the number that actually matters to you as an owner or an investor. It's the cash the business generates after you subtract the money needed just to keep the lights on. You know, things like repairing old machines or replacing equipment. This is the true spendable cash profit left over for shareholders. But, and this is a big but, here's the crazy paradox. Sometimes the faster a company tries to grow, the poorer it actually becomes. This happens when the cost of expansion, what we call capital expenditures or CAPEX, is so massive that it just swallows up all the cash the business generates. It's like a financial black hole. Let's watch this play out in real time. Imagine a company whose business is just booming. It generates a nice, cool $1 million in operating cash flow. Looks fantastic on the surface, right? The core business is a cash-generating machine.
But, this CEO is obsessed with growth and decides to build 2 massive new factories this year. The price tag? A whopping $1.2 million. This is the company's capital expenditure, and it's a huge cash outflow.
So you do the math? What's actually left over? You take that $1 million in cash from operations, and you subtract the $1.2 million spent on those new factories. The free cash flow is negative $200,000. So even though the business is profitable and growing like crazy, this company is literally bleeding cash. If it can't borrow more money fast, this rapid growth could actually kill it. Okay, so we've done all this detective work. What's the takeaway? Let's boil this all down into a simple, actionable rulebook that you can use to avoid that paper wealth trap and become a much, much smarter financial detective. Look, if you remember just one thing from our time together today, let it be this. Profit is an opinion, but cash is a fact. Accountants can argue all day about how to define profit, but the amount of money in the bank, that is undeniable. Always, always trust the cash.
So here it is, your official financial detective's checklist. First, always look beyond the net income headlines. Second, go straight to the hard evidence, the cash flow statement. Third, use those plus and minus patterns we talked about for a super quick health check. And finally, do the simple math on free cash flow to see if a company's growth is actually creating wealth or just a bigger problem.
So I'm going to leave you with a question to chew on. The next time you see a company reporting those record-breaking profits, what's the very first thing you're going to check? You now have the tools to look past the headlines and find the real story. All right, that's all for now. Thanks for digging in with me.